Have you ever gotten an ad for an investing app? Yeah, you definitely have. Probably more times than you can count. Nowadays, investing is everywhere. On social media, YouTube, TikTok, your favorite websites, you can't escape it. And if you've been paying attention, you've probably noticed that two types of investments get the most attention: Forex trading and stock market investing. But what do these two actually mean? What's the difference between them? And more importantly, which one should you choose? Today, I'm breaking down everything you need to know as a beginner. By the end of this video, you'll fully understand what stocks really are, how Forex trading works, the pros and cons of both, which one is safer, which is better for beginners, and how to make a smart decision before you invest your first dollar. So grab a notebook, because this is your complete guide to Forex versus stocks explained simply. Let's jump in. Let's start with stocks because this is the foundation of all investing. A stock, also called a share, is simply a small piece of ownership in a company. When you buy a stock, you're buying a slice of that business. But why does a company sell slices of itself? To raise money? Just imagine this. Frank wants to start a luxury shoe company. He needs $1 million to hire staff, open a shop, buy materials, and get started. But he only has $100,000. So what does he do? He asks investors, including you, to buy parts of his company. Let's say 10 people each invest $100,000. Now the company has the full $1 million to start operations. Each investor now owns 10% of the company. A year later, the business becomes a huge success and is now worth $10 million. If you own 10%, your share is now worth $1 million. That's how stock investing works. You're buying into companies that you believe will grow in value over time. Now, there are two main ways people invest in stocks. The first is buy and hold investing. This is what legendary investors like Warren Buffett do. You buy stocks of strong, reliable companies, and you hold them for years, even decades, letting them grow. The second way is speculation, or short-term trading. With this method, you buy a stock when it's cheap and sell it when the price goes up, sometimes in a single day, sometimes in a week. But here's the truth. The short-term strategy is very risky. Stock prices move up and down every second. You can make money fast, but you can lose money even faster. Long-term investing has been proven over and over again to be the safest and most reliable approach to building wealth. Now let's talk about Forex, also known as FX or foreign exchange trading. Forex trading is not about buying companies. It's about buying and selling currencies like dollars, euros, or yen. Currencies have exchange rates that are constantly changing. For example, 1 euro might be equal to $1.14. If you believe the euro is going to rise in value against the dollar, you buy euros. If you're right, and the rate rises to $1.15, you sell and make a profit. But if the value drops, you lose money, sometimes very, very quickly. Forex moves incredibly fast. Major news events, political decisions, wars, inflation rates, elections, and announcements from central banks, all of these can affect currency values instantly. Forex is often marketed as an easy way to get rich fast, but in reality, Forex is significantly harder to predict than stocks. It requires fast reactions, constant monitoring of the news, and a very high tolerance for risk. One of the biggest differences between the two markets is regulation. Stock investing is heavily monitored and regulated by powerful institutions like the SEC or the Securities and Exchange Commission and FINRA. The stock exchanges themselves, like the NYSE and NASDAQ, also have strict rules. These regulations help prevent scams and insider manipulation. That doesn't mean you can lose money, you absolutely can. But the market itself is designed to be transparent. Forex, on the other hand, is largely unregulated. Forex trading is considered over-the-counter, or OTC. This means trades are made directly between two parties without a central exchange overseeing everything. Less regulation means more opportunities for scams. You've probably seen those Forex gurus on Instagram promising massive, guaranteed profits. Most of those are huge red flags. Here's another key difference: the time frame. Forex is all about short-term speculation. You buy a currency, wait for a small price move, and then sell it quickly. Most Forex trades last just a few minutes, a few hours, or maybe a few days. It's very rare for a trade to last for weeks. No one holds a currency for 10 years, hoping it will grow. That just doesn't make sense in the Forex world. Stocks, however, are perfect for long-term wealth building. Most people buy stocks for long-term growth. As companies expand, their profits increase, and their stock prices tend to rise over time. Holding stocks for 10 to 20 years has historically been one of the most effective ways to build real, lasting wealth. This brings us to the purpose of each market. Stocks and Forex were created for fundamentally different reasons. The stock market is built on value. People invest in companies because they believe those companies will grow and become more profitable over time. Retirement accounts, index funds, and mutual funds all use stocks to build long-term wealth for millions of people. The Forex market is built entirely on price fluctuations. There is no long-term value strategy in Forex. It exists solely for speculation and to facilitate international trade between countries. You are simply buying currencies temporarily to try and profit from small, rapid price changes. So, which one should you choose? Let's summarize the strengths and weaknesses of each. For stocks, the pros are that they are generally safer than Forex. They have a strong track record of long-term performance. The market is regulated and transparent, and they are perfect for building wealth slowly and steadily, which makes them much easier for beginners to get started with. The cons? Well, prices still fluctuate. Growth takes time, and it requires patience. Now, for Forex. The pros are that you can potentially make money very quickly. Even small price moves can result in a profit. You can start with low capital, and the market is open 24 hours a day. The cons are significant. It's extremely volatile and very hard to predict. It's not beginner-friendly at all. There is a major risk of scams, and it's incredibly easy to lose money fast. So, here is my recommendation for beginners. If you are a true beginner, just starting out, the safest and most sensible starting point is stocks or stock-based funds. Like ETFs and index funds, they are regulated, relatively stable, and have a proven history of creating wealth over the long term. What about Forex? That's a specialized skill that requires a ton of experience, a solid strategy, discipline, and strong emotional control. If you do decide you want to try Forex, please practice with a demo account first. And never, ever invest money that you can't afford to lose. So now that you know the difference between stocks and Forex, which one fits your strategy? Are you more of a long-term investor looking to build wealth patiently? Or are you drawn to the idea of a fast-paced, short-term trader? Tell me in the comments, I'd love to hear your thoughts. If you've traded either one before, share your experience so other beginners can learn from it. If you enjoyed this video and found it helpful, give it a thumbs up. It really helps more people discover this content. And don't forget to subscribe for more weekly videos on investing, finance, and building your financial freedom. Thanks for watching, and I'll see you in the next one.